Hi, I'm Charles Read, President of GetPayroll. A major component of payroll that's not talked about enough is compliance. Governments are imposing more, not less, requirements on companies to be the source of tax payments for the government, rather than the government doing it directly. So 75% of all revenue collected by the federal government comes through payroll. In 2020 alone, the FFCRA, the PPP, the Employee FICA Tax Deferral, and the new 1099 NEC are just some examples of the government imposing new regulations and reporting requirements without compensating companies for the work. It is almost impossible for an individual to keep up with the changing payroll regulation landscape. They have to rely on experts to keep up with all the changes, particularly in a multi-state environment, and have then the experts give employers what they need to know or do. This is why we highly recommend outsourcing your payroll, to have one less thing complicating your goal of growing and maintaining your business. Your primary focus should be your business, not things that are just incidental to your business. In the past 30 years of owning payroll businesses, we have always made it our mission to keep our clients in 100% compliance with the IRS. This includes talking to IRS officers and agents, responding to IRS notices, fixing IRS errors, taking cases to IRS appeals hearings, and even going all the way to U.S. tax court to dispute claims, if necessary, at no additional charge. We include all the same services for state and local taxing authorities as well. Now, most business owners know the difference between an employee and an independent contractor, the two general types of workers. Now, it turns out there's a bit more complexity. Some workers can fall under two other categories: statutory employees and statutory non-employees. Statutory employees are independent contractors who do not necessarily meet the common law test as an employee, but have been deemed employees for federal purposes by federal statute. There are four groups of statutory employees: agent or commission drivers, full-time life insurance salespersons, traveling salespersons, and home workers. Now, for the worker to qualify, they must meet the following conditions. Services are performed by themselves personally. The worker cannot have to make any large investment in equipment or accommodations for the actual work. And they must have an ongoing relationship with the employer. Now, statutory non-employees are workers that would clearly be employees under common law test, but are treated as independent contractors because Congress chose them to be such. They are looked at by the IRS as independent contractors for income tax withholding, FICA, and FUTA taxes, as long as clear circumstances are met. There are two types of statutory non-employees: direct sellers and qualified real estate agents. The two are non-employees, and they must meet the following requirements before they're exempt from payroll tax withholding. Compensation is dependent upon the employee's sales or production, rather than how long they work. As well, they must have a contract in writing agreeing that they will not be treated as an employee for federal employment tax purposes. When it comes to payroll, there's one word that no one likes to see on their pay stub: deductions. However, it is important to know what those deductions are to understand where the money's going. Although it's very likely your employees still won't be happy. There are two types of deductions. The first is voluntary deductions. An employee can voluntarily agree to wage deductions that must be implemented by the payroll department. These deductions may include voluntary wage assignments to repay a debt, charitable deductions, wages withheld to purchase U.S. savings bonds, credit union loan repayments, just to name a few. Then there are also voluntary deductions that are deducted from an employee's gross pay before calculating taxes. These are called pre-tax deductions. Since they reduce the employee's taxable income, they reduce the required contributions that the employee and employer must make for Social Security and Medicare taxes. They also reduce the employee's federal income tax withholding, because less taxable income means less income tax. The other type of deductions are involuntary deductions. Involuntary payroll deductions are those over which an employer or employee have little or no control. The employer is required by law to deduct specific dollar amounts of employees' pay and remit that to a person or an agency to satisfy the law. If the employer fails to deduct and remit the amount, the employer will generally be subject to a penalty equal to the amount that was required to be deducted, plus possible fines and interest. These involuntary deductions may include federal taxes, state taxes, local taxes, child support, tax levies, unpaid student loans, creditor garnishments, and more. A common problem for employers is determining the deduction amounts when several orders for involuntary deductions are received against an employee's wages. A certain amount of the employee's wages is exempt from involuntary deduction orders. If there's not enough payroll available after the amount were exempted to pay all of the orders, the employer must understand which orders to pay and how much to pay on each order. Now, there are methods to prioritize all of the various types of the orders received by the employer. It may seem highly unlikely, but the issue of what to do about unclaimed checks that are uncashed by the employees is an ongoing payroll problem. The problem arises when an employee is discharged or resigns and fails to pick up or claim any wages owed. Or an ex-employee has not cashed a check for whatever reason. Or direct deposit is returned and never reclaimed by the employee. According to state abandoned property laws, unclaimed wages become a form of abandoned property that the employer must pay over to the appropriate state treasury if they remain unclaimed for a certain number of months or years. The state laws governing abandoned property are known as ESCHEAT laws because the property escheats to the state. Every state does this. Type your state name and the word ESCHEAT into the search engine, and the State Department that handles unclaimed property should be one of the first results. Now, most states require employers to contact employees in an attempt to keep unclaimed wages from becoming abandoned property. They are also generally required to file annual reports with the state that include each employee's name, last known address, unclaimed amount, and the payment date of the unclaimed wages, and the date of the last contact with the employee. With that report, those unclaimed wages need to be sent to the state treasury, which will hold on to the money indefinitely for the individual. Some states put a minimum level such as $50, below which the unclaimed wages do not have to be reported or sent to the state because it's not worth it to the state to process such small amounts. As an employer, your responsibility for paying those wages is over when you've submitted those funds to the state, along with complete information. If the former employee contacts you sometime in the future about an amount which you've submitted to the state, have them contact the state directly. You are no longer responsible for the funds. The state is. Sending money as ESCHEAT to the state does not in any way change your tax obligations at any level. As an employer, you must track the hours that your employees work. Then you are legally required to pay them for all the time worked. The FLSA, Fair Labor Standards Act, administered by the Department of Labor, sets forth the requirements for the federally mandated 40-hour work week. However, the Congressional Portal-to-Portal Act, first passed in 1947, modifies the FLSA in several ways, including but not limited to the following. Now, certain activities are not considered working for compensation, such as traveling to or from work, or engaging in incidental activities before or after work. But the U.S. Supreme Court has ruled that the Portal-to-Portal Act requires paying employees for activities that are integral and indispensable to an employee's principal on-the-job actions. An employee cleaning up before or after work is not normally considered work time for pay. However, if the work includes working with dangerous materials, washing up may be integral and indispensable for safety purposes. If so, the employer must pay the employee for that time because it involves worker safety and is therefore compensable. Now, punching in or out of work, waiting in line for a paycheck, searches of workers for safety or anti-theft screening are not considered working time that the employer must pay the employee for. But if an employee is required to attend a training class on any subject, the employer must pay for that time. Now, an automated time and attendance tracking system makes for fast, accurate payroll preparation. No more adding up time cards, interpreting rounding rules, or keying data into spreadsheets. It also eliminates buddy punching and ghost punches. Your employees simply track their time. The time and attendance software calculates the hours based on your unique pay rules. Then it should pass that data to your payroll system to make all the earnings calculations. Would you believe in our technological advanced society, there are companies that still write payroll checks? Nothing inherently wrong with this, but it does come with its own hurdles. Anybody with a personal computer and a laser printer can create forged checks. They can copy a signature and imprint it on a fraudulent check. Check fraud is one of the largest white-collar crime industries in the country today. However, there are ways for you to stop payroll check fraud. The first way is to have a positive pay system in place. This is where you give your bank the information on the payroll checks you issue. You send a file every day you have payroll to your bank detailing the payroll checks that were issued that day for your employees. Then, whenever a check is either presented to be cashed or is deposited and presented to your bank, the bank runs the information against the positive pay file. They can check the date, the amount, the payee, and if it's ever cleared before. If it does not match the file as a good item, the bank notifies the issuer of the check, you, of the discrepancy. If you don't respond to the bank in the requisite time, they will take whatever action you've designated as a default response to either clear the check or return the check. We recommend a default of return the check. The second best way to prevent check fraud is not to have checks. We encourage direct deposit whenever possible. Direct deposit goes from your bank through the ACH, Automated Clearinghouse system, to your employee's financial institution. It's very secure and has lots of advantages. One big advantage is there's no physical check or check image for a fraud artist to copy. Your bank must guarantee good funds on outbound direct deposit, so you will not have any float on the direct deposits. The bank will charge your account no later and maybe earlier than payday. You should know, though, if you make a mistake on an employee's direct deposit and overpay them, you have the right to take the excess amount back out of their account. Your employees often don't know that by granting you the power to deposit money in their account, they are also granting you the power to take money out of their account. Now, for those who are unbanked, we recommend debit cards. Debit cards work just like direct deposit, except the employee's bank account is effectively on the card. A well-designed program does not have to cost the employee or the employer any money, as long as they all understand the limits. Now, there's been some bad publicity on payroll debit cards, but that has to do with either poorly designed or poorly understood systems, or because of employers who want to make additional money off the card system and their employees. Another fraud you should be aware of is when an employee will say they did not get their direct deposit for one reason or another, such as closing a bank account. Now, the company feels the need to get the employee paid, and in some states, the state regulators may be heavily on the employee's side. The problem is that it takes several days for a direct deposit to a closed account to work its way back to your bank. If you have a Friday payroll, it may well be next Thursday before your bank knows that a direct deposit has been returned and deposited back to your account. Then the bank has to tell you, or you have to be checking the account every day. If you issue a replacement check on Monday or Tuesday, based on what the employee says, you may be in for a surprise if the direct deposit is not returned to you. we suggest to our clients that they don't issue a check for a failed direct deposit until the direct deposit is back in their bank account. Now, if you'd like to learn more information about how to avoid payroll payment fraud and errors, check out our website at www.getpayroll.com or my new book, The Payroll Book, a guide for small businesses and startups, available at thepayrollbook.com, Amazon, or wherever fine books are sold. Thanks for listening.